All right, this is Richard C. Wilson. Welcome to the Family Office Club podcast. We have with us here today Chris Bentley from Bellatorium Resources, and welcome to the podcast, Chris.
Thanks for having me, Richard.
Great. So we've never had somebody on here before that invests in mineral rights, at least not that I can remember, and we've done a few hundred episodes. So I want to, dive into what you do, and then, I want to make sure people understand at a base level what investing in mineral rights even means, and then we'll go to maybe how you got into this in the first place. But can you address that first part?
Yeah, Richard, it's a great question. You'd be surprised about how many people I meet in the United States that don't know what mineral rights are, and it's core to who we are as Americans. Actually, are the property rights we enjoy in this country are way beyond anything in the rest of the world. There are very few places on earth where private citizens or residents enjoy the rights to the natural resource production in the ground. And so we use this term called a bundle of sticks. So when you buy real property, you have air rights, water rights, surface rights, and mineral rights. And while oil and gas are not minerals, scientifically speaking, the rights are referred to mineral rights because back when these rights were granted, they were, people were looking for gold and silver and whatnot, underneath the ground. And so in the United States, you can sell or sever those bundle of sticks. So you can sell your air rights, you can sell your water rights, you can sell your mineral rights, you can sell just a surface or an easement. Mm-hmm. And so our firm acquires mineral rights in areas that have productive oil and gas, proven reserves in the ground with existing production and upside potential. So it's real property. You can 1031 exchange in and out of mineral rights. And what a lot of people don't know too is that, you hear this term like kind thrown around with 1031s. That is, right. It doesn't mean that you have to exchange an apartment for an apartment. You can actually buy mineral rights with a 1031 exchange from a commercial property or a whatever type of real estate, as long as it's real property for real property. So,
okay.
Yep.
That's interesting. I bet most people don't know that. And I think a lot of people would like diversity in real estate. And right now people don't know, is it going to take 4 to 6 months for people to, realize that their real estate is worth less because no one's selling it today for less than they thought it was worth 2 weeks ago. So I think that's a really good point for those listening here. I want to make sure people don't miss that if they're working with a lot of their clients. I bet you people would like some more diversity in the mineral rights, whether you're listening to this now or 3 years from now, versus if they're really heavy in real estate, maybe 1 out of their 8 deals that they're looking at this year might be better to be put into mineral rights, perhaps.
Absolutely. And what we like about this asset class, like we understand that every sophisticated investor has buckets, where or tranches of capital that have different risk profiles. But, as we're experiencing today, this is something I don't think we've ever experienced in our history. Maybe this type of volatility we've experienced, but, the whole COVID-19 coronavirus outbreak, along with distressed oil prices and geopolitics going on, being in real assets at a time like this with while the money may come out of the ground, we call it, having our money in the ground and it's coming out. So if you look at this asset like rental property, your rental income will fluctuate, but it won't stop in the areas we're buying. So if you look at, the oil and gas production, the commodity price goes lower. So obviously our income goes lower. But if you're in a true rental property, right, a surface, apartment buildings or retail, and your restaurant goes out of business, you're not getting any income off of that asset. So and some people still are okay with that, right? Because at least they own a real tangible asset that, it'll come back. And whereas in the stock market, you can lose all your capital, literally overnight if if the vagaries of the market have a negative influence on a particular asset that you're in. But the what we like here is we've seen our cash flow go down, obviously, over the past couple of months, but it's still free cash flow. So there's no liability, there's no leaky faucets, there's no tenants that aren't going to pay their rent. And these major oil companies, especially in the areas where we buy, like the Permian Basin, the Eagle Ford Shale, they can't just stop producing just because oil prices are low. I mean, I guess they could, but they would lose their rights. So there's the terms of the lease say that you have to pay or produce in paying quantities, and if you don't, then you lose your rights to the lease. And so these are valuable properties that if let's say we have a smaller operator that goes out of business and they literally can't afford, and we've been through this before with properties we own. It was seamless where the new operator, a bigger player, went and bought out the smaller one. I mean, not that Anadarko was small, but you remember the Oxy buyout of Anadarko a little while back. We owned Anadarko assets, got Anadarko royalty checks in the mail, and it was seamless. All of a sudden we started getting Oxy checks for the same property. We didn't have to do anything, so.
Sure. One thing I was wondering is usually 1031 exchanges are done asset into asset, but if somebody has a fund, how does that work? Because it's not, you're getting part of many assets typically in a fund. So is that still kosher? Can it still be navigated?
Yeah. So if we were to divest, and it just depends on the capital structure of the fund, right? And so we have there's several ways to invest in mineral rights, right? You can invest in a fund in which we operate a fund, and we collect cash flow, we bundle up, and the real return comes, on the arbitrage when we divest to, say, an endowment or a pension fund who's going to hold the assets in perpetuity. But, the other way is a lot of family offices are doing this, or actually just buying the assets direct. And we've sold to some family offices, and, we set them up with all the tools they need to manage the asset. And so it just depends on what their level of comfort is. There are some skill sets that help you to understand and manage the asset more efficiently and more, correctly, so to speak. But you got to keep in mind, we're buying these from people who own them directly, and they don't necessarily know what they own, right? They inherit them throughout the years. And so it's not like every mineral rights owner understands oil and gas production, or, so these are properties that have been passed down over generations. And so it doesn't take a landman. That's our career field, which is short for land manager. It's not a gender specific term, but it doesn't take a landman to manage the asset class. It's just better to understand the whole chain of title and how the oil and gas producers work. But by no means do you have to have a Bellatorum type organization to own the asset class. So we do several things at Bellatorum. We manage a fund. We also advise family offices that own these assets and help them manage their assets for a nominal fee. And then we also provide land management services. So.
Okay. And how did you get into this in the first place? I think a lot of people work for big oil and gas companies. Sometimes they get a petroleum engineering degree, or they, their first job, out of school is working in the finance department or the engineering department of a oil and gas firm. Many times we hear when we speak to people who invest in this space. So how did you get started in the space, and when was that?
It's actually a funny story, Richard. I joined the Marine Corps right after I got out of high school. So July of '99, went off to boot camp, and I thought I was going to be a lifer. While I was in the Marine Corps, I enlisted, but I got accepted for an officer program. So I was fortunate enough to go to college, and I got a degree in political science with a focus on international relations. Cause again, I thought I was going to be a lifer in the Corps, and that's a good undergraduate degree for an aspiring officer. Well,
Hmm.
during my time in, I did 6 deployments, several to Iraq and several to Afghanistan, and had some injuries that were pretty minor, and ended up having to get surgery. But in 2012, there was a big downsizing in the military, and budgets were being cut, and it lasted. So basically, if you had any injuries, the way they were able to trim the fat, so to speak, was to anybody who had any existing injuries that had them on a light duty status, they were giving medical discharges to. And so that's what happened to me. And so when I got out of the Marine Corps, I had a degree in political science, and I was like, what am I going to do? So I moved back to Texas, where I'm from. At the time, Houston was the #1 economy in the country. So we chose Houston. Oil and gas was booming. And, being from Texas, I had a natural affinity to the industry. And, but the only technical job you can get, at least the type of job I wanted to get with that type of undergraduate experience was an entry-level position as a landman, or again, a petroleum land manager. Also, sometimes people use these interchangeably while they're not the same thing. A right-of-way agent, and right-of-way guys focus on the surface easements for pipelines and things like that. So luckily, I was able to get a job as a landman and a right-of-way agent. I got exposed to a lot. Worked for 2 years for a company, and then when oil started crashing at the end of 2015, I got laid off a few days before Christmas of 2015, and I just thought, hey, I never want to. I want to be my own boss, so I never get laid off again. And so we started Bellatorum in May of 2016. My wife told me that if I could do some deals and prove to her that this was a viable business plan, that she'd quit her job. She was a management consultant at the time. I think at the time she was working on a project for British Petroleum, and I texted her a screenshot of the bank account one day and said, "Hey, put in your notice. I need your help in the business," and the rest is history.
Yeah, that's awesome. Great. Well, congrats. I think I ran into someone recently when I was in Colorado who was in real estate, and they had a ex-military background, both the founder and the CEO, COO, and they seem like very sharp, hardworking, like extra disciplined professionals compared to most other. Not that the other real estate professionals are unprofessional, but the way they held themselves, the way they respected them, their own health, the way that they executed on things, even in their marketing materials, they talked about that. So I wanted to bring that up here about, what difference you think it's made, either with that being in your background, or maybe you've hired a few people that are veterans as well as part of your strategy.
No, absolutely. It's a great question. I'm glad you brought it up, Richard, because there were 2 reasons for wanting to hire veterans. One, it's there's a social component to it, and it is extremely difficult for veterans who get out of the military to find work, and especially if you're a veteran without a technical degree such as engineering or doctors obviously are in a different category. But especially when senior enlisted guys get out, finding meaningful employment is very difficult. So I had always hoped to have an organization where I could hire somebody for fit, right, and then train them, hire them for cultural fit and train them, and offer these newly transitioning veterans meaningful employment. So I think we've achieved that. We hire primarily veterans, and but it also helps with the discipline, the execution, and the culture, the work ethic, everything that that I guess we might be stereotyped for in a positive way in the military. We have those things at Bellatorum. And I like to give the analogy, Richard, and I think a lot of people really don't understand the impact of this, but if you think about the U.S. military, and probably any military around the world actually, but we take people from all walks of life, all over the country, myself included, from East Texas, from a town that nobody's probably ever heard of, and take these 18-year-old kids and teach them how to do amazing things like fixing fighter jets and nuclear aircraft carrier, the engines and submarines and all these things that our military does is primarily executed by, people with no formal education. That their formal education comes from the U.S. military. Well, the way we're able to achieve that, and I think, not to oversimplify it, but it's because we have very strict standard operating procedures and checklists. You train and you don't deviate from those. And so what we've done at Dollar Forum is we've created a very, militaristic style of SOPs and checklists. And so it makes our training process easier, but it also makes our quality control mechanisms, pretty sound. And, I'm not saying we're perfect, but I would argue that our speed to execution and our accuracy of execution are far beyond any of our competitors. So.
Right. Yeah, no, that makes sense. I mean, I know as a CEO that it's definitely helped us a lot having more consistency in processes and checklists, but it can be a frustrating thing as a team leader if you give someone instructions and there's just, whether it's 3 parts or 12 parts to it, and then you go and you look at the execution. And like yesterday, we were sending an offer to buy a company through one of the companies I'm on the board of. I told them they should go and try to buy this company that's a broken deal from 3 years ago. And I told them exactly what to say in the email. They sent the email out and they got 2 out of the 5 points I told them to mention. So I said, okay, well, the next time, let me draft the email, send it to you, and you just send what I said because, I respect this group. They have a lot going on, just like every human being does, but it's so key in business to be paying attention to the details when serving investors or negotiating deals or following up with a client while being able to move fast while there's 20 other things going on. You still have to execute with excellence and not deviate, like what you said, from what the said plan was or what the best practice is. I think that's something so critical to the investment world, right?
Absolutely.
Yeah, I feel like that topic right there almost never gets talked about in our space for some reason. I mean, I'm sure you talk about it every day because that's your life, but it doesn't come up too often. Like with my other investors, it hasn't come up before at any of the 140 events that we've hosted here at the Family Office Club. So I appreciate you bringing that up. And I know we have just a couple of minutes left here, so I want to respect your time. But if somebody is trying to get their arms around, investing in mineral rights, trying to understand what you do in comparison to investing in maybe non-operating working interests or oil and gas royalties they might hear about or other oil drilling investments, can you help compartmentalize a little bit the scope of what you do versus other types of oil and gas investments, just so somebody who's a bit new to the space can make sense of it mentally? So in going forward, they can kind of make sure they're comparing apples to apples when they see other investment options in the industry.
Absolutely. Absolutely. So you mentioned oil and gas royalties, which that's what we do. I mean, we use those terms interchangeably, mineral rights or oil and gas royalties. And what's great about these versus non-op working interest is that working interests have a lot of liability with them. So as a working interest owner, you are a partner with the driller. So you've agreed to take on, some of the risk associated with that in liability. So if some extra costs come up in that process of drilling the well and maintaining it, if there's maintenance that comes up unexpectedly or a blowout or anything like that, you have to pony up your pro rata share of the investment. What's great about being in mineral rights or oil and gas royalties is that it's free cash flow. You get paid every barrel of oil that comes out of the ground, and you are the property rights owner. And so you have a lot of the negotiating power. So for example, we talked about what happens if, that company goes out of business, right? And those wells, are shut in. Well, we still own the property and there's still proven reserves in the ground. And more than likely a major is going to come buy out that smaller operator that couldn't, didn't have the financial wherewithal to keep operating in a distressed environment. So we love it. I mean, it's definitely the free cash flow component of the asset class with no liability is the attractive thing of it. And that's why pension funds and endowments love to own these assets in perpetuity, because while the yield may be, volatile, it's definitely long term. I mean, once they put wells on, they'll produce for 50 to 70 years sometimes, even, and so and potentially even longer, right? Because there's some the recovery of the reserves in the ground is never 100%. So until the world either moves away from hydrocarbons, or the producers figure out how to get every hydrocarbon out of the ground, that asset will have value in perpetuity.
Sure. And I know you said earlier the words non-op working interests, and for people that aren't deep in the space, it's non-operating working interests. And I have to tell you, the first time I heard that, maybe I don't know, 7 to 10 years ago, I thought, oh, non-operating working interests, so these are like broken wells that are not operating. And I think that there's confusion sometimes around terms thrown around, just like in the family office industry. People hear of a multifamily office and they think it's real estate related, but it's really a type of a wealth management solution. So can you just define exactly? I know you said that you basically are a partner in the operation, and that way you have more liability with non-operating working interest. But can you just define, why do they use that label? If you are a partner in it, but it's called non-operating, it doesn't literally mean the thing is not operating. It just kind of means your role in it is that you are a partner, but you're
Right.
not mechanically, moving the machinery around on the dirt. Is that most of it?
So, exactly.
Okay.
You covered it. So non-op, meaning you're a non-op, you're a non-operating partner. So we refer to the Exxons and Chevrons of the world as operators, right? So they're out operating the well and the drilling operations and everything. But so they're the operator. It's like the company, right? You have an operator and you have a financial partner, and you're just a financial partner. So, when I say you have the liabilities, I mean, as a non-op guy, you won't be sued for somebody having a safety mishap and be, drug out in front of Congress when an offshore well blows up and pollutes the Gulf of Mexico, but you will lose all your money, so that's where we talk about the liability. You have a lot of financial liability associated with being a non-op working interest owner. However, that doesn't mean that you can't make money. Obviously, you participate on the larger share of the revenue, right? So if everything goes well, you can make a lot of money in working interest. So,
Sure. Yeah. And then I guess I have one more question I'm just curious about. So you mentioned maybe 6 weeks ago, and we had a call about how some real estate investors like this because of the hard asset nature of it. But what about the income of it? Like, a lot of people in real estate look at cap rates and what's the cash flow going to be and the cash dividends. Is this the type of investment where you hold it gets improved, you sell it for more because of either market momentum or market timing or improvements to the project? Or is this a type of investment typically that, it's producing a 7% cash flow, and then you sell it to the next group, and maybe if you've timed it right or you've arbitraged some sort of pocket of inefficient deals, the value goes up, but you've also cash flowed?
Yeah, absolutely. So the cash flow is somewhat unpredictable and volatile, right? Because it's based on commodity price, and it's also based on volume, right? So we only buy Bellatorum. I'm not saying other mineral rights and oil and gas royalty companies, but Bellatorum only buys producing assets, and we only buy in Texas. And that's because we have there's specific property rights in Texas that are way better than other states in the United States, in our opinion. The mineral rights owner in Texas is superior. So the reason that's important to understand, when you talk about cash flow, the way that's related to your cash flow question is, if we buy ahead of the drill bit, so to speak, we'll never buy completely ahead of the drill bit. So what we would refer to as a raw piece of land or acreage, right? But let's say it has one well on it, and we know they can fit 12 more wells on that acreage position, so that the yield is going to be low, but there's upside potential, right? And that's where what you talked about, the yield. If we're making again, our business model is not to brag about the cash flow on the royalty income. It's about the arbitrage on bundling and selling to the longer term institutions. Those guys won't do the on the ground deals, as you can imagine. When a pension fund wants to buy a portfolio of mineral rights, they're not going to do these $50,000, $100,000 deals like we do. So we're referred to as an aggregator. And so the types of assets we're bundling up, that, the yield's not going to be that great. I mean, I think last year we had, I think 11% yield, which was, is respectable. But again,
that's pretty good.
Yeah, that's not our model. So when we divest the portfolio, that's where the real return's gonna come to our investors.
Okay.
But the pension fund, so for them, because they're paying us obviously a margin, their yield might be on average 4 to 6% over 50 years, but there could be years where it's up 30%, depending on commodity price, how many new wells get drilled. You follow what I'm saying? So the volume in the commodity price could go up and you could have a fantastic year, and then it could level out and commodity prices could go low, and you could have a horrible year where it's 2 to 3%. But over time, I think we've seen that the oil and gas royalties streams, at least provide over the course of, decades, a pretty steady average return of, 4 to 6%.
Sure. On the income side, I see. Yeah, I think 11% actually sounds pretty great. I mean, a lot of real estate investments before, the virus crisis really came up, were cash flowing maybe at 7 or 8%, et cetera. So investors who come from that world might be used to seeing less than that. But I get that that's not what drives your purchases. You're really looking for that upside on the volume, or upside on, aggregating that package together, I guess. And I mean, is it similar? It's interesting in the private equity space, people oftentimes buy companies with, say, $500,000 EBITDA, 1 million EBITDA. They bundle those together, and then they make it into a nice package at 10 million EBITDA, and they sell it to the private equity shops because they won't bother with the small stuff. So the deals need to be aggregated so that the total profits per year are meaningful enough for the big guys to care about it existing. Is that not light years away from one way that you create value?
No, it's very similar. It's already the way that you nailed it. That's the bigger institutions don't want to do what we do. That's where we add value in the value chain to both parties, right? And we actually pride ourselves on the way we interact with the small mineral owners, the mom and pops that own, 1 net royalty acre, or even 50 net royalty acres, right? Because the big guys are not going to waste their time, money, and effort on doing these small deals. So we're a liquidity option for, in a very illiquid asset class. And when a mineral owner, needs to sell their mineral rights, they don't have a lot of options, you know what I mean? At the smaller levels. And so we're a liquidity option for them. And then we add value up the food chain, so to speak, by bundling and delivering a nice, organized, package of real property, cash flowing assets with marketable title, which is important to understand as well, because when you buy surface real estate, you have a title company, they give you a title policy and all that, and there's Zillow and there's all these things and real estate agents. Well, there's not that in this asset class, even though it's real property. So we have to run the title in-house, make sure it's called marketable or defensible title, where we're giving a good chain of title to the buyer, and, being able to warrant that we actually own these assets, and that we're comfortable with the chain of title and the ownership. So that's extremely valuable to the buyers up the food chain.
Yeah, interesting. Oh, I think the next time we chat, maybe here on the podcast or otherwise, we should just go through and just define all these terms in the industry. I feel like we could spend 30 minutes just going through that, because sometimes investors look at a deck or an opportunity, and if they don't understand it, they just move on and they won't even ask someone like you questions. Or if they don't understand it, it's really hard to trust it or get high conviction on it.
Yeah.
And it's kind of a disservice to themselves not to at least be able to navigate, to select a best in class provider. And if they're trying to get exposure in this area, it's going to take them a very long time, or they're going to choose the wrong provider who just has the slick talk versus really understanding. And also it might be interesting in the future to explore, due diligence on firms like yourself. Like, what are the smartest questions that investors should be asking you, and they're never asking because they don't live and breathe what you do? Or what are the best questions you have been asked, et cetera? So maybe we can follow up some other time and dig into that, because I just feel like our space talks about private equity and buying companies all the time. We talk about real estate investing all the time, both at events and on podcasts and books, et cetera, and not as much on royalties and mineral rights. So I look forward to following up with you sometime to kind of add some more content to our community in those areas.
No, absolutely. I would love to come back on it, if you'll have me back on. I appreciate that. And one thing I'd like to say in response to that before we wrap up is, inefficient markets and niche asset classes or niche industries are where you make a lot of money. The saying riches and niches. And so to your point, I hope that not understanding the asset class would not dissuade a sophisticated investor from digging into our company and our opportunities further, because that is exactly why we're able to deliver such great returns and have a good track record, is because it's so niche and it's not going to last forever. Right. So all markets eventually become efficient, and somebody is going to invent real estate agencies and the Zillows and things of that nature for this asset class. And you got to take advantage while there's still a bunch of information asymmetry and inefficiency in this particular asset class.
Right. Yeah, no, totally agree. What's the best place for someone to get a hold of you if they want to learn more?
We have a contact page on our website, bellatorum.com. I mean, people can call me directly at our offices, 832-559-8217. And Chris at bellatorum.com is my email. I'd be happy to field any questions and inquiries.
All right, great. Yeah, and if anyone has trouble getting a hold of him, just let us know. He's a member inside the Family Office Club, so happy to help make the connection. So yeah, thanks for your time, Chris, and advice and insights, and we look forward to having you back on sometime soon.
Thanks a bunch, Richard. I really enjoyed it.